Hey everybody, Chris Luther here with the Chris Luther Real Estate team at EXP, and today we're being joined by Kevin Miller at Fairway Mortgage. And so Kevin, appreciate you being here today. Wanted to kind of bring you in, and right now rates are a hot button topic for everybody. As we're shooting this video, we are a little more than halfway into October and coming up on the holidays, and so things are changing pretty rapidly in our industry. So thought it'd be a good idea just to kind of come in and talk to you today about not only what we're seeing in the market, but what you're seeing on your side from the mortgage standpoint. And maybe, none of us have a crystal ball, but maybe talk about how some of the pressures that we're seeing with our clients, how we're navigating them and how we can help them. So, I guess we'll just start there. Let's talk about a couple of the things. Obviously, we know rates have gone up quite a bit in a very short period of time. You go back 3-4 months ago, everybody's in the market and they're talking 2 and 3% rates. Mm-hmm. But the problem is everybody is having to spend $30,000, $40,000, $50,000 above asking price to get the house.
Absolutely. I mean, you're talking about interest rates that were historically never seen ever. COVID and any number of things you could list there. Fed buying bonds, everything else. So you're comparing, that were the lowest in historic averages ever,
Sure.
to now pushing some numbers that we haven't seen since, early 2000s, 2006, 2008. So if anybody was in that, ballpark and remembers it, or even in the late 90s, those numbers weren't what they were today.
Absolutely. And so now, obviously that was not too long ago. Everybody's got that fresh on their mind, but then we have a fast change to where now, rates have jumped, 4 or 5 points depending on where you're at. And so somebody now that wants to buy, they're finding themselves in a couple of, issues that they're trying to get through. One, they may not be able to qualify today for what they qualified for, before, which obviously is a problem in itself. But obviously with the rates, the price goes up. That same house that they wanted now costs more. But I think one of the things that we're trying to educate our folks on, and I think you can speak to this pretty well, is that, it's really not so much about the rate today, because you're not going to carry that rate for 30 years. I mean, the average American keeps their rates 6 years. So
historically, it's 5 to 7 is usually what it's been. We saw a little bit longer when inventory was tough, that kind of thing. But yeah, true. Like I'm telling everybody right now, this is not, you marry the house, date the rate.
Sure.
So finding the right property, one that meets all of your needs, the square footage, you need the yard, you need this, whatever it may be. Right now we're in an anomaly, just like we were back when we were seeing a low anomaly, right? So at this point now it's about, hey, get into the home that you love, and understand that you're not going to be in that mortgage for 30 years, and that's where I think the mentality from a buyer standpoint needs to change, because they need to understand that, okay, wait a minute, I'm not going to get one mortgage and that's the only mortgage I'll ever going to get.
Right, yeah, and that's the thing for us, we're telling our folks, look, here's the deal. You got to think of it like this. Like if you were in the market 3 months ago, and many of these buyers they were beating their heads against the wall because the rate was great. It was a 2 or 3% rate, whatever that may be. But, they were in competition with so many buyers that they were having to pay $30,000 to $50,000 over. And we're talking, on a $300,000 house. I mean, that's 20% of the house that they're having to go above and beyond the list price, battle with appraisal issues, paying in most cases above what an appraisal would come in at. Just to get that house. And that's great. Your payment may be low, but wouldn't it be a better situation? We come into the market now, we have a little bit higher rate, but let's get the house at the right price today. And then let's have a plan for getting that mortgage down in the next 2-3 years, so that they're not having to absorb that over a long period of time. So what can you really say, like, what are you seeing with your folks, how you're talking them through that
Like
process?
you said, I mean, there was challenges, right, in COVID, you know, during that, and when we were seeing these increasing inventories and everyone's overpricing, you know, so there was buyers that were going, well, I don't have $30,000 or $40,000 extra, you know, to put into a home. Mm-hmm. So now the challenges is kind of shifted to, okay, now I got to deal with my debt ratio because interest rates are higher. So some of the first steps, obviously, is getting with a professional lender and going through and looking at where you're at, you know, and okay, rates are higher, sure, but all right, if your debt ratio isn't where it needs to be, so what can you do to fix that? What can you do to position yourself to be ready to pull that trigger and move right into it? Okay, that's one aspect of it. Utilizing some additional programs that are available now. You have the down payment assistance programs or the USDA loans and things like that. That, you know, maybe they don't need as much money, but they can, you know, leverage that cash into something else. Sure. These are programs that you and I know that you couldn't get those accepted, you know, back then.
Right. Absolutely.
So now utilizing your skill set with your team and saying, hey, maybe we can get that seller to help us out with some closing costs. Well, what does that mean? Well, that means that, okay, now I can pay off this debt because I don't have to put it down in down payment.
Right.
Well, many mortgage programs allow you to pay a debt off at the closing table to qualify for the mortgage.
Yeah.
So that allows them that opportunity to get in there. You have programs like the 2-1 buy down that you and I have talked about. You know, that's a great opportunity to help them offset, you know, some of that cost during those first 2 years of a loan, right? And at that point, they can have any number of options beyond that. So looking at those kind of programs and saying, okay, it's not just about acquiring a house and saying, okay, bye. It's now about a game plan, like you said, anywhere from 9, 12, 18 months down the line, you know. Additionally, programs like we have out there called Lock, Shop, and Go. So that allows a borrower to actually lock an interest rate while they're pre-approved without a home selected. And they have 90 days then to go out and shop.
Yeah.
You know?
Oh, wow.
And the caveat side to that is when they do get the contract and they're 30 days away from closing, they can float the rate down, which is known as, to get that rate closer to what the market value is at that time. But this gives them that security of knowing I can qualify at this higher rate if I had to, and I have it secured. It's not going to go above this, right, but I might be able to get it down.
Well, and I think it's important what you're talking about with that program being a 90-day lock, because I think a lot of people may not realize if they just, you know, pick up the phone and start calling any old mortgage person, you know, usually when they ask them, well, what's my rate going to be, they're giving them a 30-day, you know, number on a rate lock, which, you know, that may sound good, but in theory for somebody that hasn't bought a house and they don't understand the timeline, for you to be able to find the house, get through due diligence, and close the deal in less than 30 days, like it hardly ever happens. And so, you know, they may say something on the phone that sounds good, but then when it comes to close time, we got a surprise at the table because, oh, well, that was only for 30 days. Now the rate's this. So I think you having that lock up front with not having to have your property picked out already,
sure,
you know, you can say, okay, I'm locked for 90 days. Now I got a 90-day period, which is much more doable to go out and say, all right, let's find, we know what we qualify for, we know what the rate's going to be, let's go find that house, get it under contract, and let's close. So I think that's a really key point. I want to circle back real quick to something you were talking about is, you know, some of the 2-1 buy downs and some of the other things. And I think, you know, the reason that we're talking about some of that today is that, you know, in addition to what we talked about previously, we're in a little more position from a buyer standpoint to have some leverage. Now, you know, as agents, whether we're working for the seller or that buyer, we're always looking for points of leverage. And so 3 months ago, the buyer had no leverage, unless they were cash, and they still didn't have leverage. And so, you know, it sounds funny, but that was, the market has turned so much from that perspective, but now we've introduced some leverage points back into the buyer because now that rate spike has happened, what's happened is that's pulled a lot of buyers out of the market.
Sure.
And so now the sellers, you know, used to, we put a house on the market on Friday, and on Sunday at 5, we're saying, hey, Mr. Seller, pick one, you know, and we've got a handful of offers, and obviously they're way over ask, and they're going to somebody with, you know, they may not be all cash, but they're going to have a lot of money to put down, and they're going to be willing to pay any appraisal gaps. So great scenario for the sellers. But today, as we sit in this current market, that has changed a lot. And
Getting a
so
little more close to what it used to be. That, I mean, we used to see a lot more seller concessions. They didn't have to be massive amounts, but we used to see a lot more. Okay, $1,000 here, $500 there, those different things. I mean, those were gone forever, for a long time, right? But now it's like being able to work with you and say, hey, Chris, like we love this house. It's perfect. It's got everything. What do you think? Again, working with professional, realtors and knowing, doing the research, saying, I know this house is worth X. If we can get in here and come strong with this offer, I think we can get it. Utilizing, we could probably ask for these concessions now without having our offer thrown out the window, and those concessions can be used in numerous things. They can be used to buy down the rate. They could be used towards closing costs. They could be used to, looking at the 2-1 buy downs, things like that. So, there's a lot of ways that you can utilize those funds now that weren't available anymore.
Right.
Well,
and that's the thing, and what we like to do is, I know the buyer sometimes points right away, if we're looking at a house and we say, okay, well, let's look at this price. We want to make an offer. The immediate, buyer reaction is, well, what do we offer? Let's offer less. It's been on the market 2 weeks.
Mm-hmm.
Let's offer less, which, sounds crazy, but that's what we're in right now.
Sure.
But, what our job and what we, in conjunction with a professional like you, come in, we say, okay, well, that's a strategy, but let's really look and say, okay, if we have a $350,000, house, instead of offering them $340,000, is there a better way to use that $10,000? And I'm just using general math. So obviously each house, we look at the numbers individually, but, would it make sense instead of saying, Mr. Seller, I want to, offer you $340,000 for this house that you've got listed at $350,000, why don't we say, hey, have you heard about a 2-1 buy down? It's the same thing to you. We're offering you full price, but we're asking for a $10,000 concession and using that for a 2% less rate the first year and then a 1% reduction the second year, which saves you a lot of money on your payments, and that buys you up to 2 years for that rate to come down, and now you can lock in that lower payment.
Restructure at that point, any number of things, because things can happen during that time frame. We're expecting things to be lower in that period, so it's like, okay, great, I can utilize, not only get a lower monthly payment, but when you think about it, when your interest rate is lower, you're putting more money into principal to the house. Yeah. So now 2 years from now, you're going to owe less on that same exact deal if you didn't have that reduction, right? And especially if it's not coming out of the buyer's pocket, right? So that's a huge way for them to kind of take advantage of this, and not only the period that we have right now, while the inflation issues and all that things get kind of hashed out, and then at the end of it come back and say, okay, now we still love the house, of course, we're living there, this is still our home and everything else. Now we can talk about restructuring that financing, and I think that's where loan officers like myself have to change a little bit too. It's not about everyone was rushing through and there were so many deals happening and everyone was just scrambling to try to get a loan done. We forgot about part of our job was to educate those buyers and really go through and say, this is not just about acquiring the house today, but what's it going to look like in a year, 2 years, 3 years.
Well, and that's the thing. You operate your business like us. It's not about that house. It's about the long-term relationship with the client. And so, our job number one is, yes, what can we do to get you in the house that you want today, so that if you're a renter, you're paying yourself back and building into your future as opposed to paying the landlord and padding his pocket. But we're also wanting to make sure that we have a plan, whether it's 2 years, 5 years, 15 years, whatever that may be, because the other part of that is we have to, as agents, and same thing with you, is evaluate and say, how long do you see yourself in this house? And not everybody knows that, but most people know if their intention is for that to be their forever home, or if it's, oh no, this is going to be a 5-year at most deal, and then we're going to move up. So those kind of things help us figure out how to structure not only an offer, but the loan itself to get them the best situation for today and moving towards their next goal. So
you just made a good point, and I actually just had this conversation with a client recently. He was a single father, and he was going through, he was trying to figure out what he can do, and we had the conversation about short-term, long-term acquisition of a property versus, forever homes. And, he's, limited on funds, limited on things, his price point was limited, so we talked a lot about that exact concept. getting into that first house, you know, and you know, it doesn't necessarily be, this will be the first time he's first time home buyer, he's never owned a home before, you know, understanding that this is a asset that he's buying, right? And 2 years, 3 years down the line, that asset is going to be worth more money. You know, we use the term move up buyers or move up, you know, all the time, right? You know, well, you don't necessarily just jump into buying a $600,000 home. Most of those folks have had a few homes, you know, prior to, and they took those equity, that money that they made off the sale, and they rolled that into bigger and better things over time. So he kind of didn't think about it that way. You know, he came in thinking that, okay, the only thing I need to spend this amount of money and it's got to have everything that I ever want, you know. So I think changing that and educating folks with that mentality of saying, look, there's a great house out there that's a great home for you for the next, say, 3 or 5 years, you know, and he has a young child. So we were talking about, okay, well, how old is he going to be at that point? You know, all right, now school districts might be a factor. So things like that. And now he can turn around and say, well, I can take this money that I made from the sale and I can go up to that next level home. I think so many people have tried to hit the home run right off the bat. You know, and we have a lot of, you know, retirees that come down here. We know they're coming in with the intention of this is the last house they probably will buy. But it's a different scenario. So we're able to navigate them together.
But they're also coming with equity because they bought a house or two or three before, and they know how this works. And now they say, well, I can sell there and I can get the same thing down here. And I may not even have a mortgage. But, you know, but even the ones that come down, the point of that is, you know, and this is kind of going to segue me to my last point because I think we'd be remiss if we didn't talk about prices a little bit. And we're kind of focusing a lot of our conversation on rates. But, you know, we've been hearing, and we always hear, you know, when you have markets go up and down or whatever, now we're kind of in a little bit of an uptrend in terms of home prices, you know, now starting to stall a little bit. But, you know, I get asked several times a week, you know, or told, hey, I think I'm just going to wait till the prices come down. Well, you know, in another market, you may be able to do that. But what I would tell people, you know, we live in a coastal environment. So you got a couple things that you just have to know right now is A, there's not going to be near enough inventory come back on the market because it's a supply and demand thing. You know, prices are only going to come down if there's a ton of supply and little demand. Well, you know, with all the Fed stuff and without trying to get into a political conversation, you know, their strategy right now is to, with some of the rate hikes, suppress some of the demand. That's the way they've chosen to handle this. There's nothing we can do about that. But the problem is the gap between the supply and demand right now for our market in the coastal environment. You would have to, I mean, just, you wouldn't believe how many more houses they'd have to build and people would have to put on the market for there to be more of an even market. It is still a seller's market. And we're always going to have that demand in a coastal environment because, and here's the other thing that we've learned in the last 18 months to 2 years is we always got the people from coming up north. You know, they get older, like me. You know, the bones start to get cold, and they want to go to the warm weather, and so we're always going to get those folks. But in that last 18 months, particularly post-COVID, we've gotten so many West Coast buyers now for a variety of reasons, but now people are not stuck to the city that their office is in. And so we have had more and more West Coasters coming.
Workers are huge now.
And they're like, well, I don't have to go to my office. And hey, I'm living in California, or I'm living in Seattle, or I'm living in Denver. You know, I can come for almost half the price and get something here. You know, that's the other thing that people, I think people have seen prices go up, but they still, you have to look at it on a macro level and say, you know, we still have a pretty good cost of living here compared to up north and out west. So I think that is still going to drive that demand so consistently that person that's telling me I'm going to wait till prices come down, they're waiting on a train that's not coming. And so, and that may sound like a sales talk from an agent, but my job is to educate them. But I don't want them to miss out if they can buy today, and 2 years down the road look what equity I would have missed out on if I wouldn't have listened to Chris and just waited for the houses to drop, and they didn't drop.
Well, you said it's not just the primaries though. It's not just people moving from other locations here, because you said we are a vacation area. So that means you're also getting people looking for second homes.
Yeah.
You're also getting for investment, investors coming out looking at investment properties. So everyone's gobbling up these properties, not just the person that lives here full time.
Yeah.
So like we see that a lot with investors coming in and they're gobbling up these properties that would historically always been first-time home buyers or starter homes or whatever, and they're picking them up and they're getting great deals on them, and maybe they're renting them out, maybe they're Airbnb or whatever it is, right? So that you're competing against them as well as everybody else that's trying to move down. Not building enough, we just don't have, in some cases, we just don't have the land like New Hampshire County, in general to build. So we're out of space from that perspective.
Yeah.
So all of those things factor into, these challenges, and people say, well, I'm going to wait. Okay, well, let's think about that. If you say you're going to wait for the rate to go down, that's great. But if the price of the home goes up so let's just say even in a year or two, all right, maybe it's up 5 to 10%. Well, all of a sudden you're looking at it and going, well, you thought you did great, but all you did really was maybe you saved a few dollars on the mortgage, but you lost the equity and you had to put more money into the deal.
And you're going to pay more on the life of the loan if the price is higher by the time the rates drop. So, I think that's the message there. It's not so much, we got to buy today, but it's understand what the cause and effect of market today versus market possibly in the spring looks like. So, and naturally everybody, springtime is, that's when the sellers come out, that's when the buyers come out. And that's, yes, that's when there is more stuff. But to the point right now, coming into the end of the year, somebody that really wants to buy some of these programs that we've talked about, get them in the house, and they have more leverage to get a deal. So get the deal now, and then eat a little bit of a rate, hike temporarily, until everything changes. And it's going to change. I mean, that's the thing is, regardless of what political side you fall on, we are coming into an election season. And so nobody wants things to be bad. So there's going to be some pressure for everybody to have things, start to get a little better.
Politics are always going to impact financials, right? And if there is a change to, political party and, in the White House or whatnot, well, then they're going to go their direction versus the other direction. So anytime there's a change, and before that, they all want it to look good. So if they're getting reelected or trying to get elected, they're going to be pushing to try to make it look better, But I will spin one other thing off on the idea of now versus later. Look at the prices of rentals right now. I mean, a one-bedroom apartment, if you can find one, I'm hearing people say anywhere from $1,800 to $2,100 for a one-bedroom in some of these complexes, and a lot of them require you make 3 or 4 times the amount of rent and income just to even step forward.
Well, and that's the thing is, like I was sitting in a restaurant the other day, and I was at the bar and heard 2 of the workers there just talking about a 1-bedroom apartment, like you said, their lease was getting ready to come up and renew, and now the landlord was raising $600. I mean, could you imagine? I mean, for a 1-bedroom, but the thing is, it's like, okay, well, what do? I either pay that, but a lot of people just spend and they go pay it and not think about, okay, some people will say, well, I'm not sure I have the credit, or I'm not sure I have the down payment. To your point with the down payment system, we have a lot of different ways to get you in a home and start paying into your future rather than paying that landlord. So, because chances are you're probably, if you look at apples to apples on what you'd rent this house for versus buy it, you're probably, if not better on the mortgage side, you're probably at least going to be a wash. So if you're a wash, why not pay yourself instead of paying Kevin, the landlord?
It's been kind of crazy to look at that lately, because like when I first moved to Wilmington like 12, 13 years ago, and I look at the numbers then, you could say, well, sure, the mortgage would be this and rent's this and it's cheaper to rent. It's now getting to that point, like you said, that you're either paying within a couple $100 or, at the same number. And now you own it, because when people talk about we've been harping on the rate, the interest rate on a rental is 100%, so if it's a 7% interest rate versus 100%.
It sounds like a pretty good deal, doesn't it?
So, and at least, again, you're building some of that equity. The biggest thing most people asset-wise have is going to be their home, right?
Absolutely.
You might have a decent 401k, but at the end of the day, if you compare what your house is worth to what, what's in your investment accounts, for most people, I mean, certainly there's some people out there that blow that number out of the water, but it is going to be the highest asset you have.
Well, and the other thing is, and this is not something we talk to a lot of folks about, but as we stretch out into the future, it also gives you the ability, if you do run into a tough time, if you've bought right and you've done right, now you've got the ability to tap into some equity, whether it's to send your kid to college, or you want to do some improvements to a house, or you want to go do this or whatever, if you've bought and now you've built some time and you've paid some house down, but your value has gone up, as we've seen, who knew, without going into numbers, but I bought in 2017 the house that I'm in now, and I'm sitting on a couple $100,000 worth of equity. The timing was right, that's great, and that doesn't necessarily happen. 2 to 4% appreciation is what you would expect a year, but even at that, that's paying yourself and giving you the leverage to do some things with your money down the road.
Well, 2 to 4% appreciation in an asset that you own under your name versus paying typically 1% increases to a rental every year.
Yeah.
At least, right? So
and getting no benefit out of it.
And coming out of there with absolutely nothing.
Yeah.
Other than somebody that says you paid rent on time. That's all you really get.
Yeah.
So and a lot of times even that we've talked about credit. Most, unless you ask for it or go through some steps, most rentals don't even report to your credit. So you could have you rent a property for 2, 3, 5 years, whatever it is.
Right.
It will never give you a positive influence. Whereas you pay a mortgage payment for 2 years straight on time.
True.
That's people that are trying to build credit, think about that. And now these days, I think you've seen it, and probably everything's starting to look at credit.
Yeah.
Your car insurance, your homeowners, even cell phones are starting to look at different things, and so it's kind of crazy when you think about it. Is this this is not just going to impact you here, but it's going to impact other things. To think about that, it's insurance is the one that jumps out at me right away, because those are constantly numbers that seem to always be creeping up a little.
Yeah.
And they're always going to look for an opportunity. Well, if you can go from paying, let's say, $1,000 a year to for your car insurance, down to $600 a year for your car insurance because you have a 700 credit or 740 credit,
Right.
That's long-term savings that you're going to have.
Yeah.
And all you had to do was buy a place that you were actually living in, which again solved another purpose that you did. So
Yeah.
you got it can be kind of tied to so many things.
Yeah. Well, and I know we're making it all sound good, but at the end of the day, our hope is that, we wanted to touch on some things about today's market, and I know rates are a sensitive subject. So as we wrap up, just wanted to kind of have a frank conversation about what we're seeing in the market, things that we're doing to help our clients, and making sure that they understand the benefits of, even in a market right now with high rates, what those benefits are of buying rather than renting. So, as obviously appreciate Kevin coming on today. As we wrap up, we're going to put Kevin's stuff will be on the screen here. So if you've got any questions, we'll have Kevin's number and phone number, email, all that, every way to get to him. And at the end of the day, if you're not sure, you just got questions, reach out to us, reach out to Kevin, ask the questions. There's no cost to ask the questions, but that's what we're here for. So we want to make sure that, you understand the situation, because everything's different for every person. Yeah. And I know Kevin sees this because, there is no one size fits all when it comes to mortgage. We have plenty of people that come to us with all kinds of situations, and, they kind of talk to us about that stuff, and then we say, okay, you know what? I think you need to talk to Kevin. I've got a pretty good idea based on what you told me, what I think Kevin can do some stuff for you. And then we get you with Kevin. He can kind of really dig in and find out.
It's about a plan.
Yeah.
That's really what it comes down to. And don't be afraid to come out and talk with somebody. I'm happy to answer any of your questions. It's not about, I know people get concerned about credit pulls and this, that, the other. But have the conversation. Explain what's going on. I've been doing this for 22 years at this point. I assure you there's probably nothing I haven't heard. So, things happen in life. You don't have to, feel concerned about maybe not being a perfect, I have some dings on the credit. Yeah. It doesn't matter.
We're not here to judge you. We're here to help you. And so whether you're concerned about credit or you're not sure about, how your bank account's set up or what, it doesn't matter. We've seen it all and we can help you navigate through that. And also don't worry if you're like, well, I'm not sure if I'll be ready, in a year. Maybe I'm not ready now, but even if you're not ready now and you think, oh, maybe I want to buy in a year, maybe you're in a lease for another 9 months, whatever. It will pay for you to go ahead and call us now, because the other part of that benefit is we may be able to put you in a better position knowing that, hey, you're 9 months out, and if you contact us in 8 months, we don't have any time to change your situation, but we can also coach you through, okay, here's A, B, and C, that plan that we're talking about to get you in a better position to get a lower rate. Not just the rates in general, but rates are also based on your credit score. So if we have an opportunity for a 6-month period to look at your credit and say, hey, if you just do this, this, and this, we can probably raise your points 50 points or whatever potentially. I mean,
you've done it before.
That's something you guys do all the time.
Get somebody together, get the right person in place, and then once we know we have a viable thing, we know what we're good. Lease is coming up, say in a few months, but we know everyone's ready to go. Well, they've now talked with you or your team and said, hey, I'm looking for this type of property in this area. Now it's also giving your team the opportunity to stay on the lookout for that property that's coming up. Well, when it hits, it's like, wait, you know what? Oh, the Joneses, they're ready to go, and this house is coming to market. A friend of mine told me they're going to list it. It'd be perfect for them.
Time is always a good thing. Like, when we have time, we can plan. When we don't have time, we scramble. Now, we still get it done, but it's better for you. It's better for us. The more time that we have. So if you're somebody out there that's thinking about, buying, maybe it's in the next year, go ahead and reach out to us. Let's at least have a conversation. Try and set up a plan and say, all right, here's what the best scenario is for you. So with that, I think we're going to call it a wrap for today. Appreciate you coming in, and guys, hope you appreciate this content. If you've got questions, comments, obviously put those in the comments in the YouTube section, but feel free to reach out to either one of us, text, email, phone call. We would love to talk to you and try and sort out your situation and put you in the best plan to get you in a home and start building your future. All right, thanks for the time, guys. We'll see you on the next one.
Thank you.